We're taking a look at the currency market now with Shireen Darmalingam, Macroeconomic Strategist at Standard Bank. Thanks so much, Shireen, for joining us today. So we know that the path of the rand depends on the latest news regarding the sovereign debt crisis in both the Eurozone economies and the US. We saw further weakness coming through yesterday, and that taking the local unit to a one-week low against the dollar. So indications still that Euro matters are dominating right now.
Yes, Alishia, yesterday we saw the gold price and US Treasuries rally, while funding currencies like the dollar and the yen continue to soar, which really is an indication that of how bearish conditions how bearish the conditions have become over the past couple of days. We're also seeing equity markets continue to sell off, and volatility levels are at highs that we last saw in August. We also have an indication that yesterday's PMI data, which came out of the US economy, proved better than expected. But within the sector, the conditions really remained very pedestrian. And in the Eurozone, for instance, we have a lack of consensus among the Eurozone countries regarding that debt position there. So it's really putting a drag on sentiment. And because of these rising risk aversion that we're seeing, we expect the dollar to continue to breach the 830, which is really opens the door towards 849 and possibly even 857.
We've got emerging market currencies pretty much in the same boat here, but the rand seems to be more vulnerable. And when it comes to factors influencing this vulnerability, I've come across some market players saying that you've got players shorting the rand in anticipation of an unwinding of local rates positions, and that one of the factors that put the rand in an increasingly vulnerable position.
Yes, Alishia, we are seeing that emerging market currencies are weakening across the board, but more so for the rand, as you mentioned, and that also could be possibly because the rand is a little bit more liquid than the other emerging market economies, and it's easier for them to get out of those positions that they have been in, and foreigners have been unwinding those equity and bond positions. So we are seeing that our currency come under significant pressure over the past couple of days, especially with that risk-off environment.
You've touched on all that persists in the Eurozone. You've touched on economic data that's filtered through from the US as well. Amidst it all, where does our local data fit into the picture at the moment? Because yesterday we had local PMI data come in better than expected, showing that we saw that index move beyond the 50 mark, which separates contraction from expansion.
Well, that data was really very encouraging, being above 50, but what is very concerning is the fact that the employment subcomponent still remained below 50, and is an indication that the labour market is still going to be in for a very tough time, and with the manufacturing sector contributing a large percentage towards GDP, and the fact that we had seen a loss of about 68,000 jobs according to the quarterly labour force survey in the second quarter of this year, it is concerning that the sector may continue to contract in the second and possibly even the final quarter of this year. So the reading of 50.7 points in September is encouraging, but I don't think we should take too much of that number into account, especially given the fact that conditions in the local economy is still very bearish at the moment, and we could continue to see that fall off in the second half of this year.
Added to the negativity on the employment index component, we had the new order sales also remaining below 50, and that for a third consecutive month. So illustrating that we haven't seen that positive numbers eradicate concerns completely. What was interesting was I was chatting to Abdul Davids of Kagiso yesterday, and he said that we had the business conditions index jumping sharply to 60.8%, and much of that sentiment driven right now, and much of that sentiment driven behind the kind of weakness we've seen filtered through on the local unit.
Yes, and that is likely to encourage exporters in the market over the next coming months. But as you mentioned, it is sentiment at this point, and it has been causing that number to increase. But the underlying conditions in the manufacturing sector remain soft. We also have to bear in mind that the previous 2 months' data was really affected by the strike activity, which has dissipated now. But going forward, the soft conditions in the sector and in the economy as a whole is going to put us a dampener on those numbers going forward. We could possibly see the numbers possibly float above the 50 benchmark line, if I can put it that way. But the conditions, as I mentioned, is a bit of a concern as we go through. Demand conditions are still relatively soft, and we're seeing an increase in prices, which could put a dampener on that number as well.
Very quickly, Shireen, looking forward to today, we've got economic data coming through as well, and that in the form of sales of new motor vehicles. We're expected to see, a maintenance of growth, but a loss in momentum of that growth for the September period. Your expectations there?
Expectations for September are expected at around about 14.1%. That's from 11.1% in the previous month in August. But we also have to remember that August, September and October are generally very strong months of the year, and the final November and December could see those numbers come off slightly as consumers really delay their purchases into the new year to maintain resale value of their motor vehicles. So still another positive number which we could see coming through in October, but generally, as I mentioned before, the soft economic conditions could put a dampener on those numbers in November and December. We do expect the data to have been supported by in September by an increase in vehicle prices that were to be implemented on the 1st of October. So we do expect a relatively positive number for total passenger cars and light commercial vehicles as well. So generally an increase in growth of about 10 to 12% expected for the vehicle market for this year.
Shireen, thanks so much for your time. Shireen Darmalingam, Macroeconomic Strategist at Standard Bank.